Well, hello, everyone, and welcome. This is Cynthia Tomain with Interactive Brokers, and thank you for joining today's webinar where we'll be discussing a market update. Now, I'm very pleased to have with us today Tae Yu, who is with the Hong Kong Exchange, to talk to us more about today's session. Tae, I'm going to make you the presenter. If you would go ahead and share your slides, let's get underway here today. Thanks for joining us, Tae. Take it away.
Thank you, Cynthia. Good afternoon and good early morning to everyone who's attending this session. First of all, on behalf of Hong Kong Exchange, much appreciate this opportunity to share this session with all of you. This is actually my second session. My earlier session was 6th of May, covering the Hong Kong Exchange derivatives market. Today, I'll be covering the Hong Kong Exchange cash equity market, and also in combining to that, I'll be able to give you updates on both Stock Connect, which is China Asia investment, as well as the development in the Hong Kong market as well. So why don't we get started? For the purpose of today's session, I think it's important for me to share with you that there's a couple of disclaimers that I do need to share and update everyone on who's attending this session. First of all, I do represent on this presentation Hong Kong Exchange, and in this presentation, I will cover both Stock Exchange of Hong Kong as well as Hong Kong Securities Clearing Corporation, as well as contents and information related to Shanghai and Shenzhen Stock Exchange as well as China Clear in the context of Stock Connect. And please note that Hong Kong Exchange is not affiliated with Interactive Brokers or any other FINRA broker-dealer. So agenda for today breaks down into 5 sessions. First, I will give you an update on our business continuity management update. Second, I will cover what happened during COVID-19 pandemic period. Third, I'll cover Stock Connect, northbound shareholding and depository portfolio value. Fourth, stock suspensions in Asia markets. Fifth, further upcoming Stock Connect enhancements. It's important for me to share the business continuity management in the context of what happened during the COVID-19 volatility. As our Chief Executive Charles Lee have shared with the investors as well as market participants, that this particular COVID-19 outbreak did cause worldwide economic and social disruption and created significant market volatility. And it was very important for us to continue to ensure that our trading, clearing, and risk management systems remained functional, as well as provide that very much needed price discovery and transparency function with reliability and efficiency in place. As I share with you, this particular slide is available, and you can click on the links that has further details on information around our business continuity management. One thing that I do want to highlight is that despite the market volatility, Hong Kong Exchange was continually providing that reliable clearing and trading services throughout those periods. Our operations as well as trading hours and clearing systems were not disrupted or changed in any shape or form during those volatile periods. And that we're very pleased to inform that we're actually had zero downtime, absolutely able to provide that needed operation service that the market participants were looking for during the period of volatility. And we're very confident on our business continuity management program going forward, as it has been proven in the first quarter this year. So let's talk about what happened during COVID-19 pandemic. And it's important in the context that we compare what happened in China as it relates to onshore Asia market, what happened in Hong Kong, and then compare it to developed markets like the US and Europe, and also rest of Asia as well. So what you're seeing in the red dotted line box essentially is the index price changes from month of early April through month of early March through April 8th. And that 1 month period is what you're seeing in that what left-hand side of the percentage price change in the red line dotted box. On the right-hand side is the price change year to date from January to April 8th of this year. Also, it's important to highlight the light green box, which is what happened in Hong Kong market. And what I do want to highlight is a couple of things. One is that mainland China compared to Hong Kong market from year to date performed much better. Hong Kong market in the light green box, together with mainland China, which is the percentage that you see below, CSI 300 was minus 8.7%. Shanghai Stock Exchange 50 index was minus 7.5. Shenzhen Stock Exchange 100 index certainly was minus 10.3%. And when you compare that with Hang Seng Index and Hang Seng China Enterprise Index, minus 8.3 and minus 7.4, you see a lot of similarities here. Now, from January to April 8th, there is a stark difference between the Hong Kong market as well as mainland China market, and that mainland China market really performed very well compared to Hong Kong market from beginning of the year to end of the year. And what was interesting is that during the period of that heightened volatility, especially in that second to fourth week of March, that Hong Kong market behaved very similarly to mainland China market, in Asia market. By comparison, what you see in North America market is S&P 500 from January to April 8th was minus 14.6. Dow Jones Index was minus 17.7. And of course, rest of Asia they behave very similarly to North America. Nikkei 225 Japan was minus 8.2. Kospi Korea was minus 17.8. Europe also DAX index in Germany minus 22%. FTSE 100 UK was minus 25.2%. So what you're seeing here is that a couple of observation points can be extracted. One is mainland China Asia market performs very differently in the time of COVID-19 period, and that Hong Kong market in the beginning of the year behaved very similarly to Asia as well as Europe and US. However, in coming into that month of March to early part of April, it behaved more similarly to mainland China market. And we can talk about how the Asia market behaved quite differently from the Hong Kong market as well as I go to the subsequent slides. Investor feedback is always important, and we did conduct what we would consider soft market feedback. In particular, wanted to get a snapshot on what the investors were dealing with during COVID-19 period, and the feedback were very interesting. And allow me to share with you a couple of key points from the investors. First of all, overall across global markets, the observation is that globally every market was suffering through significant volatility in global scale. and that uncertainty around volatility really transpired into different reactions from different exchanges in their markets, in particular, either market closures or changing of the exchange trading rules. And these type of changes really transpired in unspecified period, certainly creating that uncertainty. And in times of volatility, uncertainty creates more anxiety, and to a certain extent, uncertainty drives too. Certainly, the inability for investors to continuously participate and look at and observe the market to discover price. And that certainly played into the picture of investors having to not only deal with the market volatility, but the stress of that uncertainties around market closures and different market framework that are constantly changing around the world at different exchanges. And that created additional stress as well. Circuit breakers and trading halts, certainly repetitive triggering and changes to trigger threshold in several markets created a lot of confusion in the market. And of course, short selling ban has increased in a lot of markets. And I'll share with you some sample size of what has happened during those peak period. And certainly the temporary ban of short selling created additional stress in the market. And market participants certainly raised concerns in those key developments. So when passive long-only investors really started to look at the markets, in particular, Stock Connect market, and I'm sample sizing the A-share market here because it's important in the context of how A-share market responded during these COVID-19 period, which really were much better compared to North America or Europe or even Asian markets. And many of the investors told us that when it comes to A-share China market, that they continue to make that investment despite the volatility, and that a lot of inclusion factors such as MSCI or FTSE inclusion played a number into that. And don't forget, FTSE did include A shares in month of March during that peak period. And I'll share with you some observations there as well in the later slide. In terms of the stock suspensions, as well as the what you would consider onshore volatility, don't forget, back in year 2015, stock suspensions were number one concerns by many of the global investors. This year, no issues. Why? Because stock suspensions did not happen in the A-share market this year, despite the market volatility. And I'll share with you some of the really positive developments on that. Now, Stock Connect system capacity, as well as the BCP arrangement, business continuity planning arrangements, just performed flawlessly. We were never down during the period of volatility. And in fact, the volume was really at its peak, able to handle the capacity and the throughput requirements. And we're extremely proud that we were able to support the market in the business need points, that we were there for investors to continue to participate and price discover the A-share market. And I'll share with you some more data points on that as well. In terms of active long-only investors, definitely stock selection continue to play out. A lot of positive feedback around the stability and capacity performance of Stock Connect system as well. Lots and lots of trading, buying and selling were going on during those periods. The hedge funds and quants certainly played a significant role in terms of taking advantage of the volatility, but trading opportunities that came out, especially if you look at the background around COVID-19 period, really required a lot of a focus and attention around healthcare sector, around technology sector. When mainland China was dealing with that COVID-19, where a lot of the hospitals were servicing the confirmed cases. China was able to use technology for doctors to communicate using either high grade of 4G technology, or even in some cases able to use that initial technological advanced featuring 5G technology as well. And then China as well as Korea were the first countries to use the drone to really start spraying that antiviral medication on the streets. And during those periods, these technological drones, as well as the high definition camera, as well as high speed camera angles, were able to identify the confirmed cases and patients. And as the confirmed cases and patients were ordered to stay home, they were able to monitor these individuals fairly efficiently using the technology and monitoring devices. And that particular sector in technology providing those services, providing those communication network, providing that communication services to healthcare sector certainly played out in the form of healthcare sectors that are listed in Shenzhen Stock Exchange being extremely popular during those periods in Stock Connect. And certainly hedge funds and quantitative funds were able to take advantage of those market trends. So when you look at COVID-19 pandemic, and here I wanted to share with you a couple of snapshots around what happened in Hong Kong market. Now, Hang Seng Index, just like any other market, we're suffering. Now, on the upper left-hand side, you're seeing Hang Seng Index in navy blue, and H-share Index, which is Hang Seng China Enterprise Index in red. Certainly, there's a significant degree of downturn and some recovery towards the end of March. And then that also played out in mainland bank index, as well as mainland gas and oil constituents, and mainland property index all equally were able to deal, reflecting the stress as well as volatility of that period. While those indices were dealing and reflecting the volatility, when you look at the volume on Stock Connect, this is not what we're seeing. So what you're seeing here is the cash market. And here, this is a snapshot of Hong Kong cash market. And before I get to the A-share market, I just want to touch point on a couple of key elements here. First of all, month of March was extremely busy month for us. We were averaging 142 billion Hong Kong dollars turnover. And in particular, in that navy blue is our ordinary secondary market. On average, we were dealing with the turnover 116 billion. We also have, of course, ETF products, derivatives, warrants, CBBCs, and ordinary shares broken down into 4 different segments. We are world's #1 structured product by volume and turnover. And during that period, we were dealing with a lot of different market trends. And certainly we saw a couple of different elements play out. First of all, the ordinary shares were really flying off the shelf, trading extremely well, while what you consider the derivative-based structured products stayed fairly steady. Now, what I do want to say is the investors did not pull out. They did not increase the trading yet, but they were reacting and responding to market volatility as they should, as the structured products are designed, either giving investors benefits on the upside or downside. Investors were steadily trading through the market volatility, and that's what you're seeing here, that you're not seeing a significant decrease of the turnover. In the light yellow box here is really the ETP product. In that, what I do want to say here is that our ETF products certainly were able to enjoy the benefit of increased turnover But again, it's quite similar to what you've seen in other markets. While some ETFs were very well traded, some of the ETFs were very, very steady. And overall, what you saw was compared to last year's average coming into first quarter this year, both ETF or exchange traded product market as well as the structured product market did extremely well. And of course, our secondary ordinary share cash market did extremely well. So let's talk about what happened with our short sell as well as mainland turnover. Now, this is on the left side, the red bar represents the daily market trading value in our main board. Average value of short sell in the navy blue bar. And that light blue line chart represents the short sell to market ratio. So what this is demonstrating is that while average daily market trading value were at its peak at 116 billion, short sell did increase, which is what you would expect in the period of downturn. But because the trading turnover was so much higher, that actual percentage of the short sell to market ratio actually went down compared to month of January and February, which is really interesting. That means while short sell was increasingly getting more active during the period of peak in month of March, but there were so much more ordinary share activity going on in secondary market that actual short sell ratio actually declined. And this is what I want to share with you, that despite the volatility, Hong Kong exchange short selling regime never changed. It stayed steady. And that the list of securities eligible for short selling never changed or modified. And that it continued to support the market on short selling, which really allowed price discovery to take place. And perhaps it is in that fact that as mainland China market, which I showed you earlier, traded extremely well in the month of March, that Hong Kong was also able to follow mainland Asia market by through the means of that open market access in both short selling as well as ordinary share trading. That market was able to find the rhythm. That market was able to find that continuing element of price discovery, which really allowed market to perform very, very well in the month of March. On the right-hand side, and I thought this was important for me to share with you, that different jurisdictions took different actions to ban short selling. And France, of course, in the middle of March, when things were at its peak and were peaking, started to peak anyway in COVID-19 cases, that immediately Austria, France, UK, Belgium, Greece, Italy, EU, as well as the EU in general, but in particular, I wanted to highlight these European countries where they implemented either short selling ban. And not only that, they were renewing short selling ban to add in additional securities from the initial short selling ban that they implemented. Turkey, Indonesia, Korea followed suit in Asia as well, and Thailand. So what you really saw was globally, short selling ban was taking place, and that was each jurisdiction's way of managing the market volatility, if you will. But in Hong Kong, we did not do that. We allowed the market to play out. And then what we actually saw was extremely positive performance, while the short selling was coming in at a higher degree, but the ordinary shares were continually coming in, where both of the short selling as well as the regular trading really played that nice balance of what you'd consider a market forces really integrating very well to allow that smooth price discovery to take place. And when you look at our ETF market, And again, the similar type of trends really start to come out. And our ETFs in Hong Kong exchange, and this is in Hong Kong dollars in billion terms, through especially the fourth quarter last year, we were averaging somewhere between 6.5 to 6.7 billion Hong Kong dollars a day in terms of average daily turnover. Now, once market volatility really started to take shape, and don't forget, uh, the COVID-19 situation in mainland China really started to take shape in early part of January, and it just really continued to expand through month of February, and that you started to see the peak until the middle towards the end of March. And that during those period, ETF market also played a really positive role where the daily turnover really took place. And our first quarter this year certainly was very, very positive for our ETF market. And this data is as of April 8th of this year. From January to April 8th, we were averaging 11.3 billion in ETF compared to 2019, same period, 7 billion. Certainly plays out that 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 ordinary market access, that open market access without any impeding gating factors really allowed investors to fully participate, which really turned out to be very positive result for the market. So let's talk about Stock Connect. Um, and I apologize. I think my screen just skipped a couple, but it's okay. I'm back to where I'm supposed to be. So I want to spend a couple of minutes on this chart. And while I talked about how Hong Kong market responded, I wanted to share with you how international investors responded when it comes to mainland China, Asia market through Stock Connect. It's quite interesting to see that dynamics play out. And here, what is important is I want to share with you the northbound as well as the southbound. And northbound is international investors trading into Asia market. Southbound is mainland investors trading into Hong Kong market. And there's very, very two distinct angles and there's a couple of points that I do want to share with you on that. Now, this data is as of April 22nd, but it does include that first quarter of northbound. Now, the red bar is Shenzhen Stock Exchange. Shanghai is navy blue bar is Shanghai Stock Exchange. And there's 2 points I want to share. First of all, when you go back to a prior year, a year ago, and you see in the beginning, May 2019, you see that Shanghai Stock Exchange being bigger than Shenzhen Stock Exchange when it comes to daily turnover. And this is in renminbi in billion terms. Shanghai was 12.9 billion renminbi, where Shenzhen was 11.3. But look at where we were in March of this year. Shanghai was 18.2 billion, while Shenzhen was 24.2 billion renminbi in turnover. Now, what this is telling you is two things. First of all, as the market volatility really started to take off in mainland China, and as COVID-19 situation started to evolve in mainland China, couple of things started to play out. One is that Shenzhen Stock Exchange is different from Shanghai in a sense that over 80% of mainland China's IT and new economy companies are listed in Shenzhen Stock Exchange. Secondly, over 78% of biomedicine or biotechnology sector of Chinese companies are listed in Shenzhen Stock Exchange. And when you I don't have the breakdown in this particular chart, but when you further break down that turnover, certainly biomedicine, biosector, IT in particular were extremely popular with northbound investors by international investors. while Shenzhen Stock Exchange also on a year-to-year comparison did extremely well. The Shenzhen Stock Exchange stocks were outperforming Shanghai Stock Exchange security, and I found this very interesting. And that goes to show you that biotech, biomedicine, new economy, in particular with the IT and IT service sectors, really were getting a lot of attention from international investors, and that transpired through increased turnover in Shenzhen Stock Exchange. When you look at the Shenzhen Stock Exchange, a couple of interesting observations also come out when you compare it in the context of southbound. Now, southbound again is mainland investors investing in Hong Kong market. Now, last year was a fairly modest year for southbound. We're averaging somewhere around, again, this is a billion in Hong Kong dollar terms, 5.1 billion to somewhere between 5.1 to 6.1 billion Hong Kong dollars a day. And the red constitutes from Shenzhen Stock Exchange southbound, and navy blue is Shanghai. But here's the interesting observation. Now, mainland investors started getting extremely active in southbound, trading more Hong Kong stocks than before compared to 2019. Why? Why is this? It is interesting because, well, there's a couple of things at play here. First of all, as mainland market was dealing with market volatility, economically, of course, there's a couple of things that one has to think about when it comes to southbound. One is that southbound trading is in Hong Kong dollars. So that's mainland investors trading Hong Kong stocks in Hong Kong dollars. That means Hong Kong dollars at the peak of that early January through February period before the Fed started to lower rates, that if you recall, U.S. equity market were at its peak. U.S. dollar was extremely strong. It played out over here in a sense that Hong Kong dollar being pegged to U.S. dollars, mainland investors were investing in Hong Kong listed stocks that are traded in Hong Kong dollars. That's point one. Point two is that Hong Kong exchange has a particular stocks that mainland exchanges don't have. And when you look at most traded stocks, you clearly see that the number one, the most popular traded stock is Tencent, followed by some of the blue chip stocks such as Ping An Insurance, HSBC Holdings. Meituan is a weighted voting right dual class structure. It's the online app food delivery company that had a successful IPO with us after we changed our listing rules. So what you're seeing here is that mainland investors became extremely focused with either technology stocks that don't exist in mainland China or mainland Chinese exchanges, or that blue chip stocks, that steady blue chip stocks that are listed in Hong Kong dollars. And this is really interesting because, you know, not only did they start at 8.2 billion, which is a huge jump in turnover, but as we go into February and March, they just continue to increase their trading. The other element is that the red box, which is the southbound flow on the Shenzhen Stock Exchange portion, is by comparison, that rate of growth is much higher than the navy blue, which is the Shanghai Stock Exchange southbound channel. The reason I want to share this with you is that the channel that comes from that red box through Shenzhen Stock Exchange, most of the brokers that are intermediating that flow are retail brokers. Whereas a lot of the Shanghai Stock Exchange brokers, of course, have both retail brokers, but also has a lot of institutional investors behind them. So what this is telling us is that during the period of peak volatility, many of the onshore mainland China retail investors really looked at Hong Kong market and they really started to trade Hong Kong market extremely more actively. And not only did that happen in Shanghai Stock Exchange, but if you compare to where Shenzhen Stock Exchange red boxes were, and compared to what happened in first quarter, that mainland retail investors through Shenzhen also started to be much, much more active. And that played into our ADT turnover being over 116 billion Hong Kong dollar turnover. Because if you really think about it, as retail investors come into play, there are other type of investors that react to that, what we call chemical reaction to that the retail liquidity. Quantitative funds, hedge funds, algorithmic trading, all of these investors are now having to deal with this new type of liquidity coming in, or I should say added type of liquidity coming in, and that they were able to react and respond extremely well. And this is why you're seeing that chemical reaction not only happening in mainland China through northbound, but through southbound, mainland retail investors increasingly investing and trading their activity, increasing their trading activities in Hong Kong market, that chemical reaction. And there it was extremely important for us to keep that market open, don't change anything in terms of short selling or otherwise, that allowed the market to play out its scenario. And that this is one of the major reasons why, in our observation, that Hong Kong ordinary market behave very similarly to mainland market, in that many of the institutional investors and quant funds and algorithmic type trading investors reacted very responsively to the mainland retail investors coming into the play. At one point, consistently, southbound was over 10% of Hong Kong's entire cash market turnover. That's a pretty significant number. Now, when you look at Stock Connect, it's important to show in the context of net buy or net sell. And the consistent theme plays out here as well. Now, throughout last year, what you're seeing is a net buy, net buy, net buy, net buy. I mean, there's only one time when in May 2019 was a net sell. And then coming into March this year was net sell. Obviously, March, as you know, is redemption period, market volatility. A lot of institutional investors pulled out of equity market. Mainland China market was no exception. Having said that, there was one interesting development, which was FTSE inclusion, and I'll share with you the data later on. But only for that day in March was net buy. But what is also interesting here is that we were right back up. This is January to April 23, right back up and net buying in both Shanghai and Shenzhen. So what this chart is telling you is that, yes, Asia market also felt the investors really pulling out of the market, net selling. However, what is also interesting is that the reaction of the market itself was only the single digit, closer to high level single digit downturn on the index basis. But as you saw, the range were anywhere between 7.5 to 8% down. Not as bad as North America or in particular European market or some other Asian market as well. And the point that I'm trying to make here is that while international investors did pull out, the significant portion of mainland investors and their activities really continue to allow that stability and that positive outperformance for Asia market compared to other markets in the first quarter this year. Southbound, similar story. Now, this mainland investors, as I said, were extremely active in Hong Kong market. Look what they did in January all the way through March. In March, it was complete net buy, mainland investors. And in there, as I said earlier, that red bar is Shenzhen portion, where majority of that, if not almost all of it, is retail. Shanghai is probably 50% retail and 50% institution. What you're seeing here is the degree of retail participation is significantly higher. And that when it comes to net buy, also extremely higher compared to 2019. And this allowed that, again, chemical reaction in Hong Kong market. And it was very, very important to continue to open that market without any intermediating factors that slowed the market price discovery. And we're extremely pleased to see this type of reaction, because this just means that we're open for business, and we are extremely proud of the fact that our function as a market operator, without having to change anything or impede anything, that during the volatile period, we allowed investors to express their price discovery activities. And the result of it is exactly what you're seeing. The mainland investors saw a huge opportunity in Hong Kong, and they came in a massive way in net buy. Now, whether that's a currency reason, whether that's wishing to invest in Hong Kong securities that do not exist in mainland market, that's of course depending on each individual investor's decisions. But what we are observing is the fact that retail came in a significant way, and investors from mainland China overall came in a very significant way. Now let's talk about what happened in March. Now, as I said, it was net buy in month of March. Now, what I do want to highlight is that FTSE Russell Index do have their Asia inclusion schedule, and that original schedule was that March of 22 this year was the third and last tranche, where 10% of the index weight on the FTSE Emerging All Cap Index was supposed to buy the A shares. But because of the market volatility, FTSE made the announcement shortly before March 20, which was the trade date for the inclusion, that they decided to reduce the index inclusion schedule down to 2.5% only from original schedule 10%. So we still have 7.5% to go. But in March, they only did the buy of 2.5%. It's much smaller portion to understand that while the investors and asset managers were dealing with the global trend of redemptions and sell, that market volatility and the increased funding cost and transaction capacity, stress, all of the above, the FTSE decided to, based on FTSE investors' input, reduce the weight. But let's look at what happened here. Now, the red dotted line here is Shanghai Composite Index. The navy blue dotted line is Shenzhen Composite Index. During the month of March, just like Hong Kong, everyone went down. Not as much as US or Asia, but they did go down, minus 7% to 8% range. But what's also interesting here is that for that particular period, for Shanghai Stock Exchange, it was net buy. For Shenzhen Stock Exchange, it was net sell. Why? Because while both exchanges were both inclusion of the buy trade, Shanghai, of course, in index universe still slightly outweighs Shenzhen Stock Exchange weight in terms of the inclusion weight when it comes to the buy trade, and that played out here. But I do want to highlight one thing. Look over here what happened on March 10th. That Shenzhen Stock Exchange, of course, were much earlier the benefactor of net buys. The rest of that month of March 6 all the way to March 20 were net sell, net sell, net sell. So let's think about who came in and bought this trade here. Mainland investors, institutions. In our observation, it is not too much of a different than what happened last year. That it is fairly normal practice for active as well as hedge funds to come in and do the buy trade and build up the inventory and expecting the passive investors to come in on index inclusion days so that they build up the inventory and then they sell down on the day of the inclusion. Why? Because the passive index investors use closing auction to invest. And during the March inclusion, put to inclusion on March 20th, over 90% of the turnover went through closing auction. And that was extremely well done, the 3-minute closing auction. And during that time, of course, a lot of that inventory that was bought up during the earlier periods was sold in both Shanghai and Shenzhen. So when you see this negative number, this does take into account some of the inventories that were purchased. In addition, prior to this period, all the inventories that were purchased by perhaps actives as well as hedge funds and some of the quant funds that they're selling down here on the inventory. Okay, and this does include the net buys coming into Shenzhen, although because the index weight of the inclusion was so much smaller than expected, that's why you're seeing the negative number. So let's talk about how much is held, portfolio value. Now, Stock Connect has been a steady grower when it comes to international investors investing into A shares. And what this chart represents is the value, portfolio value that are held in custody by over 10,000 funds that are registered in Stock Connect. And I'll say 10,000 funds, okay, because we have over 10,000 SPSA accounts. And the portfolio value that you're seeing here is that red bar as well as navy blue is 2019 numbers. So from January all the way here. And this is in billion renminbi. So January of last year, 785 billion of entire northbound portfolio was held in Stock Connect. As end of December, you're seeing 1.42 trillion RMB held. Significant degree of net buy happening in northbound Stock Connect. Now you start to see a little bit of peak here coming into 2020, 1.437, 1.438, and then 1.298. Now there was, as I said, net sell for that month. Now I don't have the April figure here, but I can tell you the April number is we're right back up to 1.4 plus billion renminbi. So again, from March to April, net buy in a big way in northbound. This does take into account because of the portfolio value based on the index valuation, that this does take into account the decline of the index value. So if you really look at how much decline from month of February to March, that roughly around 10 to 11% of A shares value decline, that but compared to that, compared to that decline was not as bad. That while the market volatility was playing out in COVID-19 from January through February, it again, as I said, the case really started to mushroom and really started to incline peak in that late January to February period, that foreign investors' investment into A shares was still holding steady. Even if in the month of March it was net sell, but it was not bad overall. And then we're right back up in the month of April. And when you look at a different period of, these were MSCI inclusion in last year, May, August, and November. FTSE were June and September last year, and they were supposed to be March this year. But because of that, they're going to reschedule the remainder 7.5% in June inclusion this year. So the overall picture you're seeing is that international investors are still building inventory on A shares. It's a long game. Even the period of volatility, you're still seeing that stickiness in A share market. And that passive in addition to the passive investment coming in through index inclusion, that overall Asia market is still net positive. Now, I want to share with you a little comparison of Stock Connect to QP and RQP. And this is a little bit of busy chart, but it's an important chart nonetheless to highlight as to which channels foreign investors prefer, QP/RQP or Stock Connect. Now, when we launched Stock Connect back in November of 2014, the proportion of foreign investment, and again, this is number of shares held, okay? It's the holdings of A shares. QP and RQP continue to be the dominant factor here, but something happened in 2016 where things started to really increase in a compound aggregate growth rate of month over month. And if we measure this, it's well over double digit. Whereas in QP and RQP, you're seeing a very, very steady, if not, you don't see that growth at all. It maintains at that 20% ratio. But in Stock Connect, you see that significant growth. Now, what happened in 2016? 2016 was when mainland regulators started to implement regulatory changes into Asia markets in dealing with stock suspension issues coming from 2015 year. If you recall, there were circuit breaker issues, there were stock suspension problems in the first quarter of 2015, and that 2016 really was when regulators started to come into force, really regulating the market more tightly, introducing new elements of regulation. And on top of that, in Stock Connect, we introduced a number of different improvements in Stock Connect as well. Coming into that year 2016 to 2017, we introduced real-time delivery versus payment settlement. We allowed much more flexible multi-currency settlement in Stock Connect. So those type of market structure enhancements allowed a lot of new investors to come in, open accounts, and invest in A shares through Stock Connect rather than QP and RQP. And that continues to be the case today. Now let's talk about suspension. Talk about improvements. As I said before, year 2015, in that middle of that 2015 was the peak of suspension. And that over 1,500 cases, 1,433 actually, suspended stocks, and it was extremely difficult period for Asia market. And that through the monitoring period, that Shanghai and Shenzhen issued guidelines on stock suspension, and that suspension guidelines started to really take shape coming into that late 2016 to 2017, really started to police the activities. And this is really important because, you know, this gray line is CSI 300. You saw that peak coming in and then market crash in 2015, the huge spike in stock suspension as a result of dealing with the market volatility, which is very interesting. Now, where are we in 2020? Well, as they continue to tighten up the suspension regimes, and they perform extremely, extremely well, in particular, when it comes to Shanghai Shenzhen Stock Exchange approving or disapproving self-suspension applications by listed companies, and that CSRC's continued guidelines on suspension really further reinforced the companies to relook at stock suspensions in the mean of managing the volatility of their company stock prices. And that the companies, in the mainland companies, finally start to realize that self-suspension is not the way to manage your volatility, it's not an easy task to do that. You have to have an actual business justification to suspend the stocks, either mergers or acquisitions, significant changes in corporate structures or funding structures, or business models, there has to be a justifiable reason to self-suspend. And if the suspension is longer than 3 months, they have to go to AGM to get major shareholders' approval to self-suspend. Otherwise, they're unable to do it. Result, significant improvement. And dare I say, steady around 20 cases. Now, this is a market that had over 1,433 self-suspension during their market volatility, 20 cases. What happened in the months of January, February, and March this year during COVID-19? 20 cases. Mainland investors and regulators and exchanges worked extremely hard to make sure that stock suspensions is not the cause of market disruption. And what happened in 2015, the regulators and exchanges learned their lesson and they applied and recalibrated and adjusted. And this is what you're seeing. Stock suspension no longer is the issue of A-share market trading and no longer an issue of A-share investment anymore. Extremely impressive, isn't it? I think so. Stock Connect, special segregated account. These are settlement accounts that are opened at the fund level. We have over 10,182 accounts open. And again, you see a similar story here that after that, towards the end of 2016, coming into 2017, that you see that a steady incline. And then what happened in 2018? That little uptick, almost like a hockey stick uptick. MSCI included A shares for the first time in 2018 month of May. And when you start to see that uptick, these are new account, institutional accounts opening up in Stock Connect. The investors are getting ready to respond to the May inclusion. And you're not seeing that rate decrease at all. Now, because of COVID-19, that new accounts, that special segregated accounts opening up slowed down. We are now at 10,000, slightly over 350 plus. In the month of a few months, that account opening activity has slowed down as a result of market volatility and COVID-19 situation, which is really understandable. But we do anticipate these numbers to continue to increase as the COVID-19 global pandemic challenge continue to be addressed, and once the market is able to find its course of steadiness, we do anticipate that new accounts opening to continue. Shareholding. As I said, SPSA account is the global institutional funds at the fund level through their custody account opening for Stock Connect at the fund level. So one SPSA number equals one fund mapped to one custodian. Now, these are number of shares in billions. Red color is the number of shares that are held in SPSA account, i.e., those 10,000 plus funds with individual custody banks. This overall blue is the entire market northbound trading measure. So what you're seeing in February here is that 73 billion number of shares were held by international investors for northbound, of which 47 billion were held in SPSA account. So what does it tell you? Over 62% of northbound investors are institutional investors, and they're fund managers. And there are more coming. Why? Because generally speaking, global fund managers that are either emerging market focused, that are benchmarked to indices like MSCI or FTSE Russell Index, but those active specialists, those active funds, many of them who have been longtime investors in Asia, the China market through Hong Kong, or who have been early adapters of Asia market through Stock Connect, there are still more funds and more investors that still need to come in. Why? Because many of these funds need to do their research, need to do their study on which companies to stock pick. Many of them still have to deal with, in particular from Europe, they have to deal with MiFID II implementation. They have to deal with Brexit. In some extent, they're still dealing with it. Now, COVID-19, all of these the economic situations really created distraction for many of these active funds with China specialty or emerging market specialty. Many of them are still China underweight, Asia underweight. And that because passive investment is continuing to increase through inclusion, that many of these active mandates have to catch up. Otherwise, they're going to create tracking error compared to the passive funds. And we're still seeing a lot of active investors who are looking to invest in China, who are looking to invest in China stock through Stock Connect. And we're extremely excited about that. So enhancements. Now, as I said, you start to see that Asia activity really started to take off. In 2016, what we invested in our Stock Connect market structure, we invested in delivering a really smooth settlement mechanism, delivery versus payment. This is where on your sell trade, share gets delivered at the same time as your payment. And of course, we continue to make the improvements, right? As I said before, in the May of 2015, during the peak of that market volatility, we did work with CSRC to clarify beneficial ownership through Stock Connect. That cleared the hurdles for many of the fund managers and asset owners. But coming into second half 2016. Working with the regulators, we abolished the aggregate quota. Prior to that, we had an aggregate quota in Stock Connect. It doesn't exist anymore. One can invest as much as they want. Shenzhen Connect really started to take off. Now, don't forget, 78% of new economy is listed in Shenzhen Stock Exchange. And Shenzhen has 3 boards. They have their main board, they have the small to medium enterprise board, and they have their HKEX board. And HKEX board is almost like a NASDAQ board, if you will. A lot of technology companies are listed there, but all 3 boards are available through Stock Connect. And then when Shenzhen Connect opened, it really started to take off in Stock Connect. In November 2017, we further enhanced our DVP to create real-time simultaneous DVP. That was an important element for UCITS funds from Europe. UCITS regulator extremely carefully reviewing Stock Connect. They required real-time DVP for them to approve that usage of SPSA account, and that was really important element for us to improve that. Daily quota, we increased that to accommodate the inclusion that were taking place in MSCI. We increased the daily quota by 4 times, and that Shanghai Stock Exchange, for the first time in history, introduced closing auction mechanism in their market to match Shenzhen Stock Exchange, which then further allowed recalibration and access for index funds to hit the close using closing auction. And that allowed many of the quant funds and active funds and hedge funds to play out that building up that inventory, as I shared with you earlier, and selling down during the rebound days to index funds. That happened in Stock Connect through northbound investor to northbound investor. And we see a lot of that happening even today. Now, I am going to talk about the Master SPSA in a moment, but I do want to say we're not done here. We have a lot of work to do in the future to further progress the Improve Connect program. We need to solve holiday trading. So this is where, when Hong Kong is holiday and mainland China is open, I will use Good Friday or Easter Monday as an example. Stock Connect northbound is closed. China is open. We are working with regulators and our partners in mainland China to provide solution here. Securities lending, short selling enhancement. Right now, Stock Connect does allow cover short selling. However, we need to further enhance the mechanism and eligibility of lenders of the short selling to make sure that more liquidity can be had through various different participants. And currently, only Hong Kong Exchange members are allowed to lend, and that we need to expand that eligibility. We are looking at improving block trading mechanism in Stock Connect. Currently, block trading is not allowed in Connect, and that's an important element for institutional investors. While the Stock Connect is settled in same renminbi, whether it's offshore renminbi or onshore renminbi, right now CNH offshore renminbi is used, but we are looking for ways to also for investors to tap into CNY onshore FX liquidity in case they need it. And we are looking into improving that. Most of all, we're looking at blockchain technology to implement into the post-trade settlement cycle of Stock Connect, along with the middle office function of Stock Connect, to improve trade confirmation and affirmation so that investors that are currently struggling with T0 settlement cycle, and don't forget, China A-share settles in same day as you trade. It settles in T-day. And that if you are an investor with middle office function in North America or Europe in out of Asia time zone, while the operations team are sleeping, that a market is closing here and lots of the middle office work needs to happen, that confirmation and affirmation of trading, settlement, as well as post-trade security settlement, all of that element by implementing blockchain, we're looking to make that a real-time settlement rather than 3 to 4 hour delay. Many of the investors are using 2-day technology to handle the T0 settlement. Once we introduce the blockchain technology, we'll be able to resolve that issue in real time. So lots of exciting enhancement that's going to come up. Now, I do want to talk about Master SPSA. Now, we made the announcement in month of March that we will launch this service this year subject to regulatory approval. And allow me to just spend a minute or so on what this is. Now, I talked about SPSA. Now, SPSA is designed for really 2 reasons. One, it's a mainland regulation requirement to make sure that investors do not oversell. And that 2, second regulatory requirement is that because investors are not allowed to oversell, it is a regulatory requirement to make sure that platform pre-trade check the sell trade that investors will do. So before investors enter the sell order, either Hong Kong Exchange or the Hong Kong brokers have to pre-trade check the sell order to make sure they have enough inventory to sell those sell entry orders, and that so that they don't oversell. Now, SPSA is designed where it's Hong Kong Exchange that's doing the pre-trade checking, not the brokers. So this is why you're seeing such a popularity in Stock Connect using SPSA, that many of the investors use SPSA to have Hong Kong Exchange, the neutral party, to do pre-trade checking. Why? Because we have mechanism to monitor and observe how much share balance you have in each account, because we operate the central security depository. And because we operate the trading system, we design the pre-trade checking by allowing look into the shareholding as well as allowing the access to the trading platform. And that allows the neutral party, us, Hong Kong Exchange platform solution, for mainly institutional investors choose multi-brokers. And because exchange is doing the pre-trade checking, the investors can choose up to 20 plus brokers, and that allows best execution for institutional investors. Fast forward, 2020. As great as SPSA is, there's one thing that is missing: average pricing. Now, average pricing is currently done through multiple brokers individually, but currently in Stock Connect, there is no single simple aggregate way of selling where fund managers enter one aggregate order to the brokers so that they know exactly what they need to execute on average price execution basis. Master SPSA will deliver this. And again, this is an optional mechanism. We realize that not all investors are the same, that some investors may not want this. They like their current SPSA setup, and that's fine. But we're going to offer this in optional form. And we're not changing anything when it comes to custody side. Anything related to post-trade settlement process, we're not changing it. It stays exactly the same as the existing SPSA. How are we doing this? Well, what we're doing is we're introducing one layer above the existing SPSA account, where the individual current SPSAs can be mapped to this one level higher, one master SPSA, so that whatever sell order comes in, the exchange system aggregates the calculation of pre-trade checking, and it's the exchange system that's doing it. So exchange system monitors and follows the instruction of the fund managers to aggregate the sellable balance. And because exchange system is pre-trade checking the sellable balance, the fund managers can rest assured that there is going to be no oversell on an aggregate basis. And that's what Master SPSA does. And that it also gives the fund managers the ability to shoot the sell order from the Master SPSA account. So that means it's the fund managers that controls the average pricing execution order generated from that one aggregate master account. And that means best execution, verification and validation, as well as the average pricing justification and best execution analysis can easily be done through Master SPSA reports and data that's associated and contained in that. Rest of the setup is pretty straightforward. There is a requirement for fund managers to submit an application to Hong Kong Exchange, and that the prerequisite requirement is that fund managers are required to read through the terms and conditions, and the terms and conditions in place for Master SPSA is non-negotiable. And once the application is submitted and approved, the account setup will be initiated by mapping the individual SPSA accounts to the Master SPSA account that's associated to that fund manager. As I said before, the application required setup is pretty straightforward. And this diagram, it's a little bit of a busy slide, but if you're interested, I would encourage you to go through it. There's also a link on our website that's dedicated to Master SPSA that gives a lot of technical information and detail as well. Now, we're still waiting for SFC approval for launch date of Master SPSA. We're going through that review process right now, and stay tuned. Once we complete the review and discussion with our regulator, that we will announce the launch date of Master SPSA. Thank you very much for your attention. This completes my presentation for today. And I know it was a lot of information that really came through, but I hope today's information that I shared with you were helpful in your either helping to understand more about what happened during COVID-19, but also give you a good amount of information on Stock Connect as well as Hong Kong cash market. So Cynthia, back to you.
Well, Tay, thank you very much for today's presentation. Now, I do want to mention there is a questions panel that's available. If you do have any questions for today's speaker, you can enter them there. But also want to point out the handouts panel that's located on the right-hand side of your screen. I do have a copy of today's presentation there and available for download if you'd like to before you do exit today's session. Also, a quick reminder, we have been recording today's event, and each of you will get a direct link to today's recorded playback soon after the session ends. So if you do want to come back and review the wealth of information that Tay has discussed here today, simply watch your inbox later on for a direct link. So, any questions that you see, Tay?
Let me see. I don't see any questions that's been raised in the platform.
Okay. Well, with that, then, we are going to exit to or conclude today's session. Thanks very much to the Hong Kong Exchange and Tay Yu for a terrific presentation here today. You can all exit using the X in the upper right-hand corner of your screen. Thanks, everyone, for your participation, and special thanks to the Hong Kong Exchange for making today's event possible. So with that, have a great rest of your day, everyone, and thanks so much.